Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, a whole lot of nothing in the market right now.
That's because everyone's waiting for some big data points, CPI, PPI.
And they're all waiting for ETF IQ. So let's get to the biggest story right now in the more than $12 trillion global ETF industry. And we start with meme mania and GameStop shares surging as Roaring Kitty himself makes a return to social media. We're going to dig into one ETF that counts the company among its top holdings.
And speaking of the retail trading crowd, they have helped to fuel the boom in option income ETFs. We're going to speak with the person connected to some of these funds, Jay Pestrichelli of Zega Financial.
Plus ESG ETFs, they're seeing red as they experience the largest net outflows ever recorded in 1 month. But as always, before we get there, we have Eric Balchunas from Bloomberg Intelligence here with us now looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So we're looking at the 1 week flows here. A whole lot of Vanguard at the top, which normally isn't that bullish, right? Because the Vanguard flows come in rain or shine. What you rather see up there is like the Qs or SPY. That's the trading crowd. So one note is the trading crowd not really into this market right now for a couple weeks now. But you definitely have the Vanguard bid. But what I've noticed that is with the trader crowd is the sector. See, XLP is 4. That's a lot of money. That's a staples ETF. And then the other one down there, XLF, is a financial sector ETF. That's interesting. You rarely see sectors in the top 10. So let's kind of like hone in on that. And we're going to find a sector on the outflows too. So let's look at the outflows. And the sector we're going to see is tech, right? Look at XLK is 3rd. And you could say Soxol is also tech. That's semiconductors. So, and TQQQ. So you have a lot of outflows from tech here and into more defensive sectors. And I think that's really the story. So let's dig into sectors even more. We don't really cover them that often, but sometimes they can predict the flows here. And this is the first chart here, but yeah, here we go. So here's the sectors in May. Number 1, consumer staples, right? And it had outflows in April, okay? Then we've got industrials and financials. Let's go to the bottom, technology. Negative 1.5 billion. It saw a ton of money come in April. So a total switch here in sectors. It's also moved from growth to value, essentially. So Katie, Scarlett, flow still coming in, Vanguard bid there, but little regime change action in the works.
A regime change in the works. Our thanks, of course, to Eric. And let's keep this conversation going now with Mike Venuto. He is CIO and co-founder of Tidal Financial Group. And of course, you're one of the biggest white label issuers in the game. And it's a really interesting space. And I want to talk about the business a little bit. Of course, you help issuers actually bring their strategies into the ETF wrapper. What's the pitch there? How much time and money does a prospective issuer actually save by going the white label route?
Yeah, so the pitch is pretty simple. It's structure, right? So if you are running an investment strategy today as a mutual fund, a hedge fund, or an SMA, sticking it in the ETF wrapper gets you new distribution, gets you new access, and probably makes structural alpha, meaning for taxable investors, you're probably going to get a better return. So it's a pretty easy pitch, right? The hard parts are all the nuances, especially today because more and more complex things keep coming to market.
How much do brand names, whether, let's just say it's Goldman Sachs or someone else, matter to the ultimate success and durability of an ETF? Or do fees at some point end up trumping that premium branding?
Sure. So I tell people the number one kind of factor you can bring for success is seed capital, right? The bring your own assets kind of concept. So converting an existing SMA, absolutely number 1. Number 2, you got to solve a problem, right? So there's a lot of people who are like, I got this next new idea or this theme, you know, this industry like that's got $10 million of revenue. It doesn't work. It doesn't solve a problem. Then comes brand, then comes network, then comes all those other things. So even Goldman or JP Morgan, if they don't have seed and a good idea that solves a problem, their brand's not going to save them and their wholesalers aren't going to save them.
That reminds me of the publishing business, right? They always ask, what's your platform, right? It's almost more important than the idea. But occasionally, just a pitch, an idea is good enough, right? It's like, we could definitely sell this. Have you ever had somebody come to you and the idea was just so overwhelming and almost the seed capital was secondary?
Block, that was one of our first.
The blockchain ETF.
Yeah, and it was just the timing of it and how much time it took. We came up with Chat and partnered with Roundhill when we saw that ticker and that idea and the zeitgeist. But the field of dreams where you can have those hits, it's pretty rare now, right? That ticker, that makes a huge difference. You can literally build an idea around a ticker.
Can I follow up there real quick? So Ethan on my team wrote a story about how IPOs are shrinking and ETF listings are growing. and how ETF listings are good for the exchanges, et cetera. But one thing about the ETF listings you notice is that tickers, there's no more 3-letter tickers. They're all 4. And the 4-letter tickers, is there going to be a shortage? I know you'd like to get the good tickers. Are you finding there's less and less of them out there?
So I think one place where we're seeing a shortage is the single names. So if there's 12 different ETFs built off Tesla, there's only so many derivations of TSL something that you can do, or NVIDIA or something like that. Last year we did an ETF with a 2-letter ticker, right? I didn't think there was any left. We did HF for essentially an LP, a hedge fund that converted into an ETF. So I do think it's harder and harder to find the tickers that have a vowel, that say a word, that resonate with people and tell the story in 4 letters. Hopefully we don't go to the Asian version where we go to what numbers.
Oh, no.
Oh, yeah.
That'll
like
be too
Social
boring.
Security numbers over there.
Yeah.
Yeah.
It's so impersonal.
No differentiation.
What's the best ETF ticker still in your mind?
I mean, I get asked this, and I have to say one that's not mine, so I go back to LIT. I think my partner helped create that one when he was at Global X, and it was one of the first thematics, and it told the story, and it was an ecosystem ticker.
LIT being, of course, the Global X lithium and battery tech ETF that we're talking about, ticker LIT. That launched in 2010, so that's a pretty early one. Going back to, again, the broader landscape right now, you're a white labeler. You help bring strategies into the ETF wrapper. I'm curious how much more competitive that's gotten. You do have Goldman. It's not quite a white label. There are some important nuances there, but they have their ETF accelerator platform, for example. They help bring their clients into the wrapper as well. Just walk us through the competitive landscape since you've been in this business for a while.
Yeah, so this might surprise people, but we do say no, right? So people come to us with ideas, we do an assessment, and we try and figure out if we think it's going to be successful. Because the truth is, no white label really makes money unless your ETF succeeds. So we want to be aligned with you. So what I am seeing is way more active. 9 out of 10 of the ideas that come to us are active now. And way, way, way more complex. Like things that could never have launched years ago are now able to launch after 6C11 and 18F4. For the audience, those are really boring regulatory things that occurred, but they really allowed for innovation in the ETF industry.
This audience loves those
Those
things.
really love those. So lots of long short, an amazing amount of derivative, combining multi-asset classes. There's all kinds of things that are coming. We helped Jerry Parker bring an ETF to market last year. He's the famous trend follower in managed futures. That thing could not have been done 4 or 5 years ago before these rules changed.
Yeah, it's a good reminder, of course, this industry, it's evolving all the time, even though it is 30 years old at this point. But let's talk about after the ETF launch, because then it feels like things get really difficult, because then you have distribution to worry about, getting on platforms, getting in front of advisors. How much more difficult has that piece gotten?
So I think it's interesting because you can have ETFs that are a hit that never even go after advisors. Right? So if you hit the shiny object, and the shiny object is no longer just performance. It can be yield, it can be downside protection, it can be that moment in the sun where you have exposure to the right thing at the right time. So I do think that the regulators have gotten more comfortable with speaking to the retail audience. Now you have to be really buttoned down to do it, but that's there. And then in terms of platforms, they're harder and harder because an indie can't just show up and get approved. You need a wholesaling staff. These platforms, the big 4 banks, they require that you have a team that can come in and educate. And that's why we've built like a platform, right? We have wholesalers, we have a marketing department, we can plug all that in for our clients.
How the sausage gets made, fascinating. You mentioned shiny object moment. What's still the shiny object moment? Is Bitcoin over? Is it all about options and the income that they could generate?
I don't think Bitcoin is over. I think we're going to be talking about ETH forever now too, because it's going to be back and forth with the regulators. I do think that the fact that they approved GBTC at the same time probably took a lot of the air out of the balloon because you had a two-way market, which if you want orderly markets, I guess that makes a lot of sense, right? So it kind of took the air away from all the degens in that space. In terms of what's next, it's complex, right? I think there's over 30 option strategies in the CFA handbook. pretty much every one of those will be an ETF of some sort on multiple different indexes and securities over the next 5 to 10 years.
All right, life gets more complicated all the time. Mike Venuto, it's great to spend some time with you. Our big thanks, of course, to Mike Venuto. Now, coming up on this show, ESG ETFs experiencing their biggest net outflows ever recorded in 1 month. We'll discuss the reason next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we actually start with mutual funds, because I love this chart behind me. You have in blue net new mutual funds. In orange, you have new ETFs. And as you can see, those blue bars, they're going down because actually over the past decade or so, about 1,000 mutual funds have been shut. So when you're taking a look at just the number of funds, the mutual fund industry is shrinking at a time when you can see that the ETF industry continues to grow. And let's also keep talking about new ETFs and the launches there, because they're actually getting more expensive. We were just talking about with Mike Venuto the fact that you have more complicated strategies launching in the ETF wrapper. That means that issuers can charge more for those strategies. So you can see the new ETFs are getting a little bit more expensive, but we're talking about, 60 basis points, so still pretty cheap in the grand scheme of things. But let's also talk about ESG. We talk about it a lot, mostly in the context of outflows, and that's what we're doing here as well, because you take a look at April 2024 and record ESG outflows last month. You can see that it was hot for a while, especially in 2021. Feels like a long time ago at this point, Scarlett.
Absolutely. So let's talk about this issue a little bit more with Shaheen Contractor of Bloomberg Intelligence. What's going on? Do we tie this to the political wins and how ESG is just out of favor right now?
So Scarlett, you're right. In the first quarter, outflows from America's ESG ETFs were about $4 billion, which is, quite substantial. I've always said that this has been, concentrated to a few funds, so it's not really this mass exodus out of ESG. At the same time, we aren't seeing inflows, and I actually tied that back to the political backlash. Investors sort of have their, I call it cautious blindfolds on, so there are no inflows, but the outflows are a bit overrated to me.
A bit overrated when it comes to those outflows. I hope that Eric Balchunas is listening, but can we talk about what actually is ESG right now? When you take a look at these funds, what do they tend to hold when it comes to their actual securities?
So you have a couple of categories, right? You have first ESG integrated, which is basically funds broadly considering ESG risks and opportunities. I have to say on average that, does tend to overweight tech. It's about 2% overweight tech versus the S&P, 2% underweight energy. On the other side, you have thematic funds, climate funds, gender funds, and carbon markets funds, for example, and they tend to take on their own themes. So that's really the broad, categorization.
So ESG funds are not seeing as much demand. They're also shutting down completely. Talk a little bit about the liquidation of these kinds of funds.
So liquidations has actually continued from last year, but at this increased pace. So I would say so far we've seen about 26 funds liquidate versus about 36 in all of last year. And I've crunched a bit of the numbers. I think ESG ETF liquidations are about 30% of total ETF liquidations, which I thought to be quite eye-opening.
Yeah, that's pretty significant, more than 1/3.
Yeah.
Shaheen, really, really great stuff. Shaheen Contractor of Bloomberg Intelligence on what's going on with those ESG ETFs. Still ahead, we're going to drill down into option income ETFs with Jay Pestrichelli of Zega Financial. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we're looking at Yield Max. We talk about hot sauce ETFs on here. These are hot sauce income. If you want a lot of income quickly, these will do it. This thing yields about 110%, which is, absurd. But how it does it takes really volatile stocks and it sells call options, 5 to 10% out of the money. So if the stock goes up quickly, those call options get exercised, so you don't get the extreme upside, but they fetch a lot of income. So you can see this thing just came out 2 months ago. It's a little on the pricey side, but again, something so exotic, usually no one cares what the fee is. The market cap is 86 million. That's pretty good for, again, such an unusual product. Let's look at what it holds. And we picked this one today because GameStop, this ETF holds more GameStop than anybody else. It has the most exposure. You can see it's the second holding. So it's about 10% of the fund is in GameStop. Now remember, GameStop's up like 60, 70% today. This ETF's up 6%. So it only gets a little taste of it. You also got Bitcoin miners. You've got some cannabis companies in here, more Bitcoin down here, MicroStrategy. So you can see this is a meme style, very volatile fund, but that's the purpose, to get that income. Let's look at the performance of this fund versus the S&P, and also I put the Yield Max Tesla in here. So you can see so much of the price comes from the yield, the total return rather, comes from the yield. So it is down a little bit, S&P's up a little bit, but mostly people are just getting this for that big yield, but the price still has to go up so you don't lose money effectively, Katie. But interesting product, especially for people searching for income.
Yeah, big time. Eric, thank you. And joining this conversation now to talk about this ETF, we have Jay Pestrichelli. He is CEO and co-founder of Zega Financial. Let's talk a little bit about the yields on these products, because you say yield and people think bond yields, which move around, but not that much. Then you take a look at some of the indicated yields on these products. They move around quite a bit, to put it mildly. So maybe, I know we just had Eric go through it, but how exactly does this work?
Yeah, Katie, it's great to be here. So the way that this strategy works is it aims to find those stocks that have high volatility in their options. We get long the stock and then sell options 5 to 10% out of the money with short dated options. That might be a week, it might be 2 weeks out. And the goal here is really to convert that high volatility into option premium that then gets distributed on a monthly basis. As you just mentioned, the first two distributions, because it is a fairly new fund, have exceeded the annual distribution rate of 100%. It's one of those things that, you know, you're looking to convert that option premium, that elevated option level, into a distribution. And without, you know, obviously, you know, nobody knew the news that was going to come out about GameStop. It was a position we put on Monday of last week. But sometimes those positions go on the money, they get called away. Next week, we rebuild the portfolio. So it is a fairly active portfolio. And again, rescreening for stocks that have, you know, higher levels of volatility. Now, Eric, you did point out that there's some concentration here in crypto and some cannabis, but the portfolio does go through, you know, a little bit of diversification screening, right? You know, 20, 25% any given sector is really where we put the limit on this. So while you can have some, you know, diversification in the fund, it's really more about the volatility than anything else and how much premium we're generating in the options market.
So you said next week we might rebuild the portfolio. How often do you rebuild this portfolio? I mean, is this something that could change daily?
You know, generally it's a weekly review of the positions that are in there because we're selling weekly options, right? Again, the goal is to harvest that weekly premium decay that you get from selling volatile covered calls. So unless those options, you know, declined in their time value really quickly, probably going to hold the positions through the end of the week. So we reassess on a pretty regular basis. I would say since the launch of the fund 2.5 months ago, there's been a fairly stable list of tickers in there. Probably half of them have been in there the whole time. GameStop has been in a few times. It just happened to be in, you know, met our screening rules last week, so it was in. But, you know, it does go through a fair bit of rotation.
And let's talk about who's buying this. Mike Venuto was just on, and I know he's your white label issuer for these. He says a lot of people who are sort of online, active, sort of do-it-yourself day traders are the main audience. Is that what you're finding? And what are they doing with these? Is it just the yield they want? They want bigger income every month?
Yeah, so the Yield Max suite in general that you're talking about, Eric, right, has 24 different funds. Most of them are single stock funds. Like, yeah, I think I just saw you had Tesla up there. You know, Coney is another popular one, NVIDIA, you know, both on Coin and NVIDIA. You know, so individual investors will rotate through those different tickers, whether, you know, earnings are coming up or they like the volatility or they like the appreciation of the underlying, they'll rotate through that. But when you start to look at funds like Alti, and even the YMAX fund, which is our fund of funds, they end up being more like an allocator and advisor using those because now you've got a diversified basket. Now, Alti is obviously volatile and I would say aggressive, but still you have diversification, right? And so when you get these multi-position funds, you start to see more advisors and allocators using them, whereas the single tickers like the Tesla and the Coney of the world end up being probably a little more on the retail side.
Let's talk about that a little bit more. We only have 30 seconds. You have TSLY, which of course is Tesla option income. Then you have CRSH, which is Crash, which is short Tesla option income ETF. Should I buy them both at the same time, or is that just a bad idea?
Yeah, I mean, Crash is brand new, by the way. When you guys were having the conversation about innovative tickers, I can't take credit for Crash. One of my partners did. I think that's a pretty good one for an inverse Tesla fund. But besides that, I would say no. You're not necessarily, to answer your question directly, you're not necessarily hedged by owning both of them. You have the chance to generate income off of both of those, and at that rate of 40 to 50%, which is what we're selling the options for. Tesla's had an historical distribution rate of that. So I don't, you're not necessarily hedged because you have it. You still have kind of the outsized risk. Direction matters when it comes to Tesla or Crash.
All right, Jay, really appreciate the time. Really fascinating suite of products you have there. 23 ETFs, as Eric Balchunas points out, all organic growth. Our big thanks to Jay Pestrichelli of Zega Financial. And if you just can't get enough of ETFs, a reminder that you can listen to Eric and Joel Weber on Trillions. That, of course, is their podcast that covers the industry. And I do want to point out two high-profile interviews we have coming up on Bloomberg. First, in just moments, you're going to hear from Bank of America CEO Brian Moynihan. He joins us exclusively from the Choose France Summit. And then, as part of our summit coverage, French President Emmanuel Macron, he will be at the top of the hour speaking to our editor-in-chief, John Micklethwaite, in a wide-ranging conversation. So don't go anywhere. You don't want to miss it. But sadly, that does it for now. For Bloomberg ETF IQ, I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas. And of course, this is Bloomberg.